Hey everyone, what's going on? It is July 6th, 2024, a couple days after the holiday. Happy 4th of July for anyone who is listening here. Um, I don't I'm really excited to talk to you guys today because I've done a lot of research this morning, which is why it's after 1 o'clock on Saturday. Usually I'll have the end of the week recaps done in the morning on Saturdays, but I've been doing a lot of research today and just doing a lot of extra work and trying to find some new things to talk about and discuss. And I'm really excited to kind of go into everything. But that being said, as always, let's go ahead and get our disclaimer out of the way. Everything we discuss is for educational educational purposes only, and is not the opinion of Trading Options Network. So take this information and do with it whatever you want to do, but take responsibility in what you do decide to do. One thing you should do, of course, like, follow, and subscribe at all of the social medias or your favorite social medias to stay up to date with everything. That being said, I'm going to go ahead and put up my camera here because I'm looking good today. No, I just want to go ahead and have you guys look at me. I guess just have some fun. But first and foremost, expect this past for first, but big banks starting to the start of the Wells Fargo and on Friday. You bit and then slow. We have Visa. Starting to so it's Feb. I guess the 14th. The ISM manufacturing PMI this which both were below 50. Okay, it looks like manufacturing PMI was expected to be below 50, but it still came in even lower than expected. Services PMI, it was expected to be 52.6. It came in at 48.8. Now, what is PMI? If I go ahead and click on it, PMI is the Purchasing Managers Index. Basically, it is a reading of a bunch of different companies, major companies here in the United States. Okay, they're not global companies, they are domestic companies. And they are going to create this report that is going to essentially tell us whether or not their spending is going up or down. And that is kind of like a leading indicator of what we should expect to happen in the market. So if it is 50, it means it basically stayed the same. It is above 50, then their spending is up. And if it is below 50, then their spending is moving down. They're retracting their spending. If it is below 50, that's usually, quote unquote, bad for the market. But right now, again, as I said the other day on Wednesday during the midweek recap, we're in this weird period where good news is good news and bad news is good news. So it almost doesn't matter what happens. News is good news. We're in that season where any news is good news. Like, what's that saying? Any publicity is good publicity. We're almost in that same situation. Any news is good news right now. Now, on Friday, we had the average hourly earnings report. We had the non-farm employment change. Then we had the unemployment rate. This is interesting to me. We actually created more jobs and more unemployment on this past report, which, is, I'm not going to necessarily say that it's conflicting information. It just is one of those strange things. Now, I will say the non-farm employment change was up substantially higher than what was expected, which, again, good news is good news. The unemployment rate, it actually came in higher than expected, which that typically is bad news, but also bad news is good news. So the market looked at this 206 and said, yay, we're expanding. And then they looked at this quote unquote bad news and said, yay, we're getting closer to rate cuts. So, again, it's in that weird season where it seems like everything is good news. Now, next week, we're going to have, of course, the CPI and the PPI that comes out. Before that, it looks like Powell's going to be speaking here on both Tuesday and Wednesday. Anytime Powell opens his mouth, we should expect some volatility. God only knows what he's going to be saying. I would not be surprised based on what we have heard recently if he's a little bit more dovish and, he might start talking about a potential rate cut. I don't know. We'll see what he says. What was it? The last FOMC meeting, he seemed to really still be quite hawkish, saying, hey, well, it looks like we're going in the right direction, but we have a long way to go and a lot more to see before we go ahead and do any rate cuts. So we'll see. We'll see what happens if he says, hey, we're seeing it now and we could potentially have a rate cut closer in the near future than we originally expected. Or he can just double down and say, hey, we're not going to have any rate cuts till the end of the year. In which case, the market's probably going to react semi-negatively to that, but who knows? Who knows? Now, CPI and PPI, those are going to be big numbers. Now, CPI is a consumer price index. The way I describe it is think of, you go into the grocery store, you get the same, few items. You need your eggs, you need your milk, you need, like in Home Alone, right? He got his milk, eggs, and fabric softener. But you get those same things. Well, the core CPI, or the CPI in general, the Consumer Price Index, is how much you're spending for those same products as time goes on. So if you get your same exact 10 products week in, week out, for example, over time you should expect to see them go up. Well, that's what the CPI is measuring. PPI, on the other hand, that's a Producer Price Index. PPI is essentially how much the manufacturers and the wholesalers and all these companies are paying or spending in order to get the product out into the market. Okay. And that's manufacturing. That's literally everything it costs for them to get that product to the market to you. Okay. So that's PPI. Now, the Producer Price Index is a leading indicator of inflation because what do you think happens if these companies start having to pay more to get that to get those products out to the consumers, well, that typically means the consumers are going to ultimately be spending more money, which of course is then going to increase CPI. So right now, we are expected to see a core CPI of 0.2%, a CPI of 0.1%, and then the year-over-year CPI to be 3.1%. So that obviously is, we're expecting a decrease there, and that's what the market's going to want to see. The difference between the core CPI and CPI. So core CPI actually removes, I want to make sure I have it the exact, the exact things. We're excluding food and energy, okay, in the CPI, in core CPI. The regular CPI includes the food and energy, okay? But food and energy is obviously a huge, huge portion of CPI. I think it's like 40% or maybe more, just those two things. So we have our core CPI and then our CPI. Same with core PPI and PPI. I believe it excludes the same two things. Source energy, food and energy prices make up about 40%. Yeah. So food and energy, 40% overall. PPI. So again, core PPI excludes that. The regular PPI includes the food and energy sectors in this case for the PPI. So, we're definitely the market is going to want to see lower numbers, or at the very least, hitting those forecasts, anything above it. And that's going to really change what a lot of people are probably thinking in terms of potential rate cuts this year. If Powell comes out and says, hey, we might be looking at a rate cut in the near future than, earlier than expected, and then the CPI and the PPI come out, quote unquote, hot, then I guarantee he's going to change his stance right away. I would not be surprised if, and honestly have no idea what he's planning on talking about, but if it is about inflation, he will probably say something along the lines of, let's just see what happens with the CPI data that's going to be coming out on Thursday, and then the PPI on Friday. So, again, the news this coming week could potentially move the market, but again, time will tell. Let's go ahead and actually look at the chart, though. Why is this not showing? Let me refresh the page. There we go. All right, so we had the market was closed on Thursday. There we go. Market was closed on Thursday. So we had Tuesday, Wednesday, Friday. 3 consecutive green bars, which those are very, very nice green bars. Now, overall, they may not be huge movers, but we gapped down on Tuesday, and we did nothing but move up. There's no wicks at all. Those are called, if I recall off the top of my head, Harami candles. And then the very next day, we didn't really gap up or down, but again, we continued to move up throughout the day. Tiny, tiny wick there. It looks like on both the top and the bottom, but they're so minuscule you almost can't even count them. And then the same thing happened. We slightly gapped up, but again, we barely came back down, and we just continued to move up throughout the day. So that is telling me that the market wants to go higher. The interesting thing here is that, the volume wasn't super high. The volume was not super high at all. It was just average volume, it looks like, but yet we got this movement here. Maybe it's because of the holiday. Maybe, a lot of people were just not, participating in the market, including companies. Who knows? One thing I do want to point out, though, is if we look back on the CCI, right here where we had the peak here, okay, that's when it gapped up on June 12th. We gapped up, and then it started moving back down. Now interestingly enough, we had a higher high in terms of the S&P price, okay? But yet we did not create a higher high in the CCI. Now, these happen so close together, it's hard to say, technically speaking, you could argue that is a bearish divergence, but, they're so close together. However, this is not close together. Okay, we've dipped below the 100 and now we popped back up over the 100, yet we are at a much higher high. I mean, we're looking at June 12th. We closed at 541, and right now we are at 554. So that's almost 3%, 2.5% higher than where we were on June 12th. Now, that being said, look at this CCI. The CCI right now, it looks like is at 165, which is still really high, don't get me wrong, but it is not over 200 like it was on June 12th. Okay? So, are we going to see bearish divergence here, or is the market going to continue to move up where it creates a new high in the CCI as well? That's going to be a hard number to surpass, but we'll see what happens, of course. Again, I don't have a crystal ball. Interestingly enough, the MACD is actually signaling that, hey, we're at a buy time right now. This is a buy signal right here, okay? The MACD itself is actually crossing over the signal line. That is a buy signal, okay? So again, MACD is giving us a buy. The CCI crossing 100 technically, I would say, is also a buy signal. A lot of people argue that it means it's overbought. I disagree, because again, every single time it crosses the 100, it seems to want to stay in the 100 and it will go up a little bit higher. Crosses the 100, it'll go up a little higher. So crosses the 100, it has so far gone up over the last couple of days. How long will this continue to move? That's the question. Okay. In terms of the map, let me refresh this page as well. So here's what happened overall last week. Now this is interesting. If we took a diagonal line from the top right to the bottom left, it's almost like, polar opposites of one another. And I'll go ahead and, let's see here. I'll just move myself over there for a second. Okay. On the flip side, if we look at it for the day, it was a lot more mixed. Okay. Nvidia was down. Tesla was up. Speaking of Tesla, look at this. This is insane. For the week, up almost 30%. Now, you can't tell me that Tesla had a little bit to do with a lot of these other bigger companies having a nice green week. It's not the exact reason why. It's not the only reason why, but if you ask me, I'd say Tesla going up almost 30%. Had a lot of people investing in these other, big blue chip, companies such as Nvidia, Apple, Microsoft, Amazon, Google, Facebook. But again, overall in the week, on Friday, it's a different picture. It's still about 50-50, just like it was for the week, but kind of more mixed throughout the different sectors. Now, here's another thing that I was looking at, which I find very interesting. I found this website that actually will show, and of course, the chart as well. Let me refresh this one as well. There it goes. All right. So, I don't know if they created these ticker symbols themselves or what. I have no idea, but I did find out that this is the S&P 500 stocks that are above the 20-day moving average. Okay, and of course, I always have my 20 and 50-day moving averages in there themselves. So as you can see, I actually put them in there. The darker green line is the 50-day moving average, and the lighter green line is the 20-day moving average. So why is this interesting to me? Well, this says that only 43% of the S&P stocks are above their 20-day moving average, which means almost 60%. That's 3 out of 5 almost of stocks are below their 20-day moving average. Well, guess what? We have the same thing for the 50-day. Here's the S&P 500 stocks above the 50-day moving average. Let me go ahead and again, I don't know why the charts aren't showing when I started this video. They were showing before I started this video, but if I go ahead and refresh this, there we go. Very, very similar number, 43.73. So 43% basically on both. Also, while we had on, so Tuesday, Wednesday, Friday, of course, the stock price itself, gosh, why is it doing this? I don't get it. All right, let me refresh this really quick. There we go. All right, so the stock price itself, or the ETF price, the S&P, had 3 consecutive green days. I'm not going to argue that. But both the 20 and the 50, or I should say the stocks that were above the 20 and the stocks that were above the 50, they both actually decreased here on Friday. They both went down. So that I find very interesting. Also, about this 50-day, if I were to zoom out in this 2-year, in fact, I'm going to actually go to the 3-year. I'm going to change weekly to daily here. See, I was playing with this before I got in this video. The amount of stocks that were over the 50-day moving average, let's see, that would have been, right at the end of January, was over 80%. That's a huge amount. I mean, 4 out of 5 stocks in the S&P were over their 50-day moving average. But look what has happened since then. It's been going down, 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 down. Yet, if we come over here and look at the actual chart of the S&P, what has been happening since the end of January? Up, 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 a little bit of a pullback, up, 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 I mean a smaller pullback, up, 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 tiniest pullback ever, and then up, 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 up. So, we have, for the most part, the amount of stocks that are over the 50-day moving average, moving down in a downward trend, yet the market has been going off. Now, what does that tell you? Well, obviously, that tells me, and it should also tell you, that the stocks that are moving the market are the NVIDIA. Let's go. I'm going to look at the 6-month performance here, but I'm going to guess that it's going to be the NVIDIAs, the Apples, the Microsofts, the Teslas, all those. Okay, let's see here. Of course, I have to refresh it again. I don't get why my computer's doing this. All right, but look at this. 6 months. Okay. NVIDIA, 164%, Microsoft, 26%, Apple, 22%, Amazon, 34%, Costco, 37%, Walmart, 31%, Google, 36%, Eli Lilly, 48%, Netflix, 46%, Tesla's the worst out of all of them, still 5%, and that's probably mainly this 30% that it just went off of, just went crazy this past week. So again, I mean, look at all these big companies, and yeah, you see these, GE here is at 62%. You'll see some other FedEx down here, 18%. ExxonMobil about 10%. But again, T-Mobile, a little over 10%. Uber 21%. ServiceNow just under 20%. Which one is that? Cadence is, I'm not sure, but it's 25%. 13% for Intuit, Qualcomm 50%. You have Intel has been taking a hit, down 32%. But again, nonetheless, because we've had so many stocks over the 50-day moving average at the end of January, we have a lot of massively green, things showing here in the S&P for the last 6 months. Now, the craziest part about this is I guarantee that if we were to look at the last 3 months, we're going to see more red, and then we'll go to 1 month, we'll see even more red. See, look at that, 3 months, a lot more red. That means a lot of these stocks that were doing really well early on are starting to slip. Yet the bigger companies, NVIDIA, Microsoft, Apple, Google, Amazon, Costco, Walmart, they're all still green. Eli Lilly, Applied Materials, they're all still pretty green. Qualcomm. What is that one? Texas Instruments, that's right. But now let's go to the 1 month. I'll bet it's even more red. You're going to see more red. Well, it's about the same as a 3 month, not necessarily more. But look at Nike down 20%, Pepsi down negative 5%, Starbucks 8%. So we're seeing a lot deeper red for sure. Maybe quote unquote the same, roughly speaking the same amount. If I go to the 3 months, I mean, again, I can't say exactly. Well, actually looking at it again, I would say, yeah, we probably are more. It just seems like it's more in this region per se. Okay. And then of course we go to that 1 week, and yeah, it's even more red in the last week. Okay. Now these are performances. Okay. These are not necessarily stocks. It's not showing stocks that are currently over the 50 or 20-day moving average or anything like that. It's just showing the performances of the last week, the last month, the last 3 months, the last 6 months. But again, as we're getting into a closer and closer time period, we're definitely seeing more and more red. If we go to the green, Tesla's still actually down 10%. But the 6 month period from January, when we were at all-time highs for, I shouldn't say all-time highs, but, highs from the last few years at least, of the amount of stocks that were over the 50-day moving average, it was a lot. Now, let's come back over here really quick, and then we're going to move on. So I'm going to go ahead and go to the 3 month chart just so we can get back to seeing it closer up. The question right now is, where do we want to go? The 20 and 50 day have been almost equal here on this. And this is interesting. I'm using the 20 and the 50 day moving average for the stocks over the 20 or in this case the 50 day moving averages in the S&P. Actually, let me zoom out. We have not seen this little action here in a long time. Let's go back to the 2 year. Again, it's been flip-flopping quite a bit. I mean, it's really never been in the same position like it's consolidating right now. I'm really, really curious to see where this goes. I mean, the amount of stocks that have been above the 50-day moving average has hardly moved. Now, we could have, as of yesterday, the close of yesterday, when we're at 43% of stocks, it could be a completely different 43% than over here when it closed at 42.74%. So again, just under 43%. It could be a different complete set of stocks, but the bottom line probably isn't. There's probably a lot that are still in there. But the interesting thing again is that it hasn't moved much. I mean, you had a little bit of a dip here, a little bit of a spike here, but for the most part, it's consolidating. What does that mean? I mean, I don't know, because if I go back for the 3 years that I can see on here, it's never really happened. You can maybe argue a little bit right there at the end of 2021, but it wasn't crossing numerous times within a month. It just barely gapped up over the 20, barely went over the 50, and then it moved right back down again. That was it. It was one cross of the 20 and the 50-day moving average between these that happened quickly. In the last 3 months, 1, 2, 3, this is almost on it together, and this is starting to split here, mainly because of this little spike here. If that spike didn't happen, the 50 and the 20 would be pretty close together still. So where do we go? I have no idea. The trend obviously is downward. So are we going to continue to see? I mean, we could literally say we have a triangle pattern here on this interesting chart. And this is an interesting chart. Now, personally, my guess, and mainly because it's an election year, is we're going to go up higher. But on the flip side, there were a lot of companies that were, saying certain things during their earnings for quarter one that was telling me, gosh, I wonder how their quarter two earnings are going to look based on what they're saying. And now with the PMI that has come out, now I'm really curious on, oops, sorry about that. Now I'm really curious on, what we should expect moving forward with these earnings, because if these companies are spending less, they're going to be making less. And while their quarter two earnings might look really good, because obviously a lot of these companies were hitting all-time highs in terms of profits, their earnings itself might be great, but what's their outlook going to be for the next quarter or next couple of quarters? I'm really curious to see how the next month or two shapes up. We could easily see 600 in the S&P if somehow, again, being that this is an election year, the market just continues to want to push higher and it's just not going to slow down. We could easily see that. Easily. Gosh. You know what? I want to change what I said because I was looking at the averages here. If I go to the 3-year, okay. So there has been a few times we have hit 90. Okay. Just a few times in the last, that's weekly. Let's go to the daily. There we go. A few times we crossed over 90% of stocks in the S&P over their 50-day moving average. And every single time that has happened, it went down at least right here. It went all the way down to under 10%. That's super bearish. And then it went down to under 20%. And even though we didn't cross 90, I mean, we were still at 89. It went down to under 10%. So should we expect this to get down to 10%? I mean, history does tend to repeat itself in the market. We could very easily see that. But again, this consolidating right here that we're having is not something we've seen before. I guess we kind of saw it right here, in which case it did dip down a little bit. And then continue moving up. So what this tells me is even though the market should be down here, it should, and I could say should be, the market can do whatever it wants. The market's going to react to the consumers. And right now, the consumers just don't want to bring down the market. So even though we should be retracing, we're not retracing. And now we are consolidating here. And just like we did kind of consolidate here, we should definitely see a big move either up or down soon. So I don't know. I don't know what to expect. I do not have a crystal ball, but I am definitely looking to see the market move in a big way here soon. Now, a couple things I wanted to talk about. I'm going to go over here to the monitor, and then we're going to go ahead and finish up. But I'm excited to say over the past week, we started, of course, with a $200,000 account. Let me go ahead and put this to all accounts here. And as of the first week, we are up almost 2%. We are at $203,903.94. Now, if you are a platinum subscriber, you would have gotten that notification that yesterday, before the market closed, for T-Mobile, we went ahead and we rolled the short legs of that diagonal and we created a vertical, okay, because T-Mobile is still looking good. So if we go to the chart here, T-Mobile is still looking good. Now, if we start retracing and we drop below our longer leg, which is, go ahead, why is it not show? Oh, no, it should be there. Why is it not there? Why is it not showing? Do I have to actually open up the margin? Give me a second. I don't know why it's doing this. It should show me the legs. Okay, it's showing them here. Did they just update this over the weekend? I wonder if they did, because this is different to me. It was not even like this past week, but nonetheless, I got to use this. So T-Mobile, as you can see, we no longer have a diagonal. We have a vertical spread. If the stock price does drop below 177.50, I will probably close it. Right now we are at 179.24. So we have a decent amount of, I mean, we could lose $2 in value. Now, what will happen there? This is really throwing me off. I don't like this. But we should expect the 180 short legs to essentially, now when we did go ahead and roll, we traded them at 119. They're at 140, 150. That's totally fine. I'm not too worried about that. But this will essentially become, there'll be no more value left there. So we'll essentially take that $120, $119 per trade or per leg there, and we'll take that as profit if it drops below the 177.50. Not all of it, okay? There'll still be some value there. So let's just say it goes down to 20 cents a leg, then we'll be up about $2,300 on those. Now, if it goes down to 177.50 on these, we will probably lose a little bit more than that, okay? So we should expect we'll probably be around $1, maybe $1.25 or so. Maybe even $1.50. I'll even go ahead and say it's $1.50. I'll be a little conservative. I'll say it's $1.50, but we're probably going to lose about $1.40 there at least. So yeah, if we go to 177.50, we will close this particular trade at a loss. However, remember, when we rolled the position for the 180 short legs, we rolled them, and if I recall, it was at like, $1.16, I think. So we had to pay about 3 cents to roll them. So in essence, we made about 70 cents per short leg on the original puts there. So that makes up for that difference that we would miss, that 40-cent difference or so, if it goes down to 177.50. I'm okay with that. If it drops below 177.50, in the end, in the grand scheme of things, we'll still be walking away with a gain. If it stays over 177.50, we're going to close. We're going to close the trade prior to the market closing on Friday for a bigger gain. And if it's over 180, then we will let them expire together. We're not going to close either trade because essentially one will be assigned and one will be exercised. So they'll cancel each other out, and we will not be left with any shares if it closes over 180. And then we'll have max gain. So looking forward to that. The SOXX ETF, that is the semiconductor ETF. We're up nicely on that one. Okay, I guess we're up $90. T-Mobile, we're up $9.20. Okay, see, I'm still getting, this is definitely an update or something. I don't know why it's reading like this. This is not how it used to read. Change it by account. No, it's the same thing. What if I had to click overall? Nope, still the same thing. Anyways, I don't like this. So it looks like for the SOXX, we are up $90 on it. We had a nice profit on it yesterday, though, $3,500. Same for Roblox, $3,300. That doesn't even make any sense to me because we're only up $4,000 on the week. We were not. We were down. We were up $3,000 on the day yesterday. So how could we have possibly been up almost $7,000 on just these two positions, only 46 down on T-Mobile? That doesn't make any sense to me. I don't know why this is different. Like, this is throwing me off, but nonetheless, I don't care about these right now. What I care is these. Profit and loss for Roblox, $3,097.50. Profit and loss for the semiconductor ETF is 90, and then T-Mobile is 920. So we're looking good on all three trades still. Okay. SOXX, if I look at the chart real quick, had a little bit of a red day. I'm not too worried about that. We're still looking decent. It could very easily continue moving up. But we still also have 2 weeks till expiration. And all we have to do is go up to the 260 for max gain. I'll probably close it if it goes above 260 and then drops below 260. I'll probably close it. But all I want it to do is get somewhere near that 260 level in the next couple of weeks. And then we'll continue to monitor it day by day at that time. If it drops below 250, we'll probably close it for a little bit of a loss. But again, you can never expect every single trade to be profitable. Anybody who tells you that is going to be lying. So that being said, we talked about a lot today. I certainly hope you learned something from this. I'm going to really have to get used to this. I do not like this at all. See, I don't know why. Yeah, this is, it's frustrating to me. I hate change when it's stuff like this. And I've been using this for a couple of years, multiple years. And now Schwab recently bought out Thinkorswim, and now they're changing this. I don't like this setup at all. This is throwing me off. But anyways, I'll get used to it eventually. And again, hope you all learned something. Look forward to see what this week brings for everyone. And